log off like that. You guys can. Oh, Omar, can you message me and tell me? Omar, you can hear me, right? It's going live. There you are. Okay, yeah, it should work. Sorry, one second. Right. Forex markets and the latest cut report. So, and then we'll talk about derivative markets and what's happening. First, as always, we go to cftc.com and then we go to Chicago Mercantile Exchange. We click on short form format and we go down to, for euro, you ignore the short term rate. You go all the way down to euro. Where are we? So Swiss franc, British pound, Japanese yen. So here we have a situation with euro. Now, this week on the euro USD, as usual, non-commercials, which is large leverage funds, applying lots of contracts. Please bear in mind that one contract of euro is 125,000 euros per contract. So this is 29,000 contracts, 422 short. This is the first time that open interest is now at the hands of the commercials. Now this market is being set up to go long. Now I did say I need to make this distinction when it comes to the COT report. Whoever controls open interest controls the market basically, or the move that is happening. In this section here that says percentage of open interest for each category, you need to look at both long and short and also see that if these two numbers are not higher than these two numbers, then that means that the commercials are in control of, finally, after almost 2 months, the commercials are now in control of Euro USD, if that makes sense. Then you have the total of all of the traders. It adds up as who's long and who's short. This is not so much important because they just add longs and shorts together. What matters is that in both categories, even if they're long and short, that these guys are in control. Now, in Larry Williams' book, How I Made $1 Million Last Year Trading Commodities, he says that the real market movers are the commercials because these are hedge funds, teachers' funds, police funds, and things like that. And so they decide. 1 minute, please. 1 second. Sorry. Let me just give this guy's link. Anyway, so on the euro chart, if we go to the weekly chart, this move started on the end of September and it lasted for 1, 2, 3, 4, 5, 6, 7, 8 weeks. Exactly 2 months. What is it? 8 weeks? 1, 2, 3, 4, 5, 6, 7, 8 weeks. So this short move lasted for 8 weeks. But the move higher, so if we get a line and we put it on January, so the move higher, going higher, was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 weeks. The difference between the commercials and the non-commercials is that the commercials have more money to hold a market more than 12 weeks long. They can hold sustain market moves. as a trader, even if you are a day trader, you should always try to trade in the long-term direction of the market, but also you should also trade in the short-term direction of the market. Now, when these guys are controlling the market, eventually they run out of money. And also the thing about Wall Street is they like to take they like to take it over the top, meaning that while these guys' attention is away in another market, now commercials trade together as a group. It is a well-known fact that they communicate with each other. Hedge funds talk to other hedge funds and they team up. The evidence for this is when British pound, George Soros and Drunken Miller wore short British pound in the 1980s. It wasn't just him; it was everyone else was copying him, and it's not a secret that there were two other funds that joined them in the trade, because he could not pull it off himself. So he got two other funds. It is legal for them to work together, but no one can prove that they're not doing it, right? Does that make sense? They work together on an idea, you know. So insider trading, no matter what people say, it still goes on. But hedge funds, they don't really manipulate the market like that. The ones who always get fined are non-commercials because they try to cheat their way. But anyway, back to on the issue of euro. Uh, we believe this trend is now over, and there will be a short squeeze happening because open interest was hijacked by the commercials finally, but open interest is still long. Now, here is what people don't understand about open interest. Although we did say that on the issue of open interest, if a market is selling and open interest is decreasing, then there is going to be a move to reverse the other way. But the thing about open interest that most people understand is it can also be positive, because they need to, by them hijacking the move, there is still an element of open interest. Now, open interest has decreased slightly, but it's still not as bad as still not bad as it's still not as bad as GBP USD, which is open interest dropped from 20,000 to 8,000, so almost 12,000 drop. Now, the move on GBP is still slightly on the side of commercials, because they still have 46%, 27, so it's like a 50-50 battle here. But they've already given up their trades on GBP USD because they removed their shorts and they removed their longs. So therefore, this removal of shorts is the mistake that the non-commercials made, because the moment they removed, these guys are up 25,905, you know. So anyway, as a general rule, also when it comes to the issue of open interest, remember I said whoever controls open interest controls the market. You need to understand is, if open interest is controlled by Wall Street, which is the non-commercials or large leverage funds as they're known as, those large speculators, sorry, they're known as large speculators. Uh, it's temporary. Although temporary can mean 2 months, real moves in the market happen. Long-term moves, the big moves happen when these guys. So if someone was long Euro USD, held his trade as a swing trade from April all the way to September, that would have been a good move, right? So it's May, June, July, August. That's 5 months. Whereas the short on euro, although the move was considerably large, only because these guys took their eye off the ball, concentrated on, like I said, hedge funds work together, so they went over to Dixie Dollar to try to short Dixie, but then it kind of flopped for them, if that makes sense. This year is the first year that Wall Street actually did well in terms of trading. It does happen sometimes over a period of years that Wall Street, they save up a lot of money and they go all in. So they only do it in election years. Most of their money, they don't have as much money as the big guys, so they save up their money, and one year they strike big. So this was an achievement on them to push euro this low. As far as technical analysis, this candle here was the candle that caused shifting market structure by taking short-term high. This was back in September 2022. This candle here is an order block. I know some people are saying that the market will go to this fair value gap. I don't think so. And that euro will be allowed to get to parity level, which is one-on-one with the dollar. As things stand, as far as the weekly chart is concerned, Commercials only step in when key levels in the market are taken. So April 2024's low was taken, and October 2023's low was taken, and the market stopped right there. And this fair value gap will be left open. The reason why I say this is if you look at the bigger picture, euro in back in the 2020s during COVID times was at 122. Now here is an issue that most people don't take into consideration. Me working in Wall Street, they teach us to use this method and look at the amount of liquid. Actually, I'll do it on the futures chart. It makes sense to do it on the futures chart. So remember, algorithms go after volumes and hedge funds go after volumes. So we'll look at 6E1, and let me just remove everything on 6E1. So I'll just remove 10 drawings. Why euro will not go back to parity? We will measure the actual, in terms of volume, we'll just measure what is the distance between, not that low that's been, just this low here to there. And I want you to visualize something. So in terms of volume, think of time taken to make is also important. In terms of volume, 371 days, volume is 55.93 million times 125,000, if that makes sense. So you need to look at it as times 125,000. This is on the futures market. That is the value from this low, 2022's low, which is below parity. So let me just put a line on parity again. So let's just say parity is there, and I just put it as, the green line represents parity. So I just put it as parity. That's the swing low. I'm talking about equal lows. So from that low to that low, this one has already been taken. So the value of this trade becomes like this now. Does that make sense? Because this low has been taken. They've took that low and that low. So there's only, for them not to take it lower in volume wise, it's only worth 10 million. Now here is the mistake that most people don't understand. What is the value of the 2021 high to this high here? Also, you have to, because of time, you have to also consider this high there. For hedge funds, they view all these guys that will short euro, and remember hedge funds think 5 years out, and because they're teachers funds, sovereign wealth fund, it is a well-known fact that the Norwegian sovereign wealth fund is in the euro market as well, and these guys are in profit. So the value of euro as things stand is, sorry, let me just go back. What did I do? Why did I do that? So this is a trick that I learned from Wall Street. And so there is 193.41 million, and it's taken 1,358 days. Think of time and volume. Algorithm seek volume. This is the weekly chart, so it will take longer. Realistically, Euro USD, we have always maintained that our long-term target is the 2021 high of 123, and the market has to go there, and it can do it over a period of 2 years, or certainly whatever happens, provided that the European Union gets a good trade deal. As far as the lows are concerned, there is no other significant low, and the consensus is to go higher, and there is more liquidity above than below, because this is what's left of below. Before this low was taken, which is the low that I'm looking at, is the October's 2023 low was taken, there is no incentive, so the liquidity available becomes less to this swing low here. And that's exactly how hedge funds view the market on the futures market. And euro, for this reason, we make the deal. If anyone wants to go long on euro USD, I would advise just wait for Tuesday or Wednesday to make the low of the week, and you buy, and you can hold for 5 years if you want, or you can hold just for the nearest swing high, which is back to 112. And this is probably going to be a 3-month trade, because the commercials will get it there. As far as Dixie dollar is concerned, so we'll look at Dixie dollar. What's the dollar? So it's held by the ICE futures markets, and I'll just remove. Right. As far as dollar is concerned, let's measure the volume from this high to this high here. It does this high doesn't matter because it was taken, so there is only because that high was taken here. So this high was, these equal highs were taken recently. So there's only, I think, only a little bit of volume left, 2.3 million volume, and there is all the way to the down. This low took that low, so the distance is from this low to that low to that low to this low and that low. So from that low all the way here. Now Dixie dollar, the contract size for Dixie dollar is I think is one of the biggest in the world. So I'll take you to ICE futures short format. I told you guys that, what the hell is going on? What? Yeah, so yeah, Marius. Sorry guys, I don't know my quality. I'm just trying to just listen to what I'm saying. So I'm on DX1 dash, if that makes sense, and the value of the Monday, the 4th of January 2021's low in the futures market to the current low. Sorry, that because that low was taken, it doesn't matter. So we have to go back a bit. The value is 16.72 million. The time taken is 900. Remaining time to be taken is 924 days, which is 132 bars. So there is more sell side liquidity for Dixie dollar. There is no incentive to go higher for the algorithms in that department, and I will show you. I was going to the ICE futures short format, and if we go to Dixie dollar, the contract value for Dixie dollar is times 1,000 commitment, 1,000. Basically, each position is like almost $1 million. It's actually more. Dixie dollar positions, although they look short, one position is like on exchange margin requirements at the CME group, at the ICE futures group, it's $1 million. So this market, no one can afford to trade Dixie dollar unless you've got capital or money behind you, basically. So so we have to times this by 16.72 million. This is in the billions of dollars, these positions. And so for that reason, we make the case that Dixie dollar long term is bearish, regardless of what is happening now. We have to take the long term view. And for that reason, Dixie dollar will go lower, if that makes sense. So as far as another case study that you guys need to keep an eye on is this is the Bank of International Settlements. And you need to look at OTC derivative statistics from the end of June 2024. Now, derivatives are, what is a derivative? And I'll just explain it to you like this. Derivatives means it is derived from something else. It is not a thing itself. It's a financial contract written about something else. As crazy as that sounds, that's what it is. And the behavior of something else. And based on the behavior of that thing, payments will be made, or there will be an obligation to pay. Now, normally derivatives originally started in the agriculture markets. So the first exchange in the agriculture markets was this one here was the first one, Chicago Board of Trade. And I think the other one is called Minneapolis. I think Minneapolis Grain Exchange were the first. That was the first markets that where derivatives were practiced. Now, derivatives originally started with agriculture markets, and farmers would sell contracts to would sell their contracts, their forward contracts, to the point where their crops were ready to be harvested. So they can lock in a price, they can lock in profit early on the promise to deliver the crops later on to commercial entities. Back in those days, everyone was happy, but something happened in the 1990s where someone figured this out and decided to take this promise to pay and promise to deliver like an IOU basically into all the other markets. And in 1999 and 2000, the dot-com bubble happened. Back in those days, in the 90s, derivatives were 2 times the size of global GDP. And then in 2007, derivatives were 10 times the size of global GDP. As of 2024, derivatives are 20 times the size of all the world's global GDP. this method of trading and promises, and it can also be futures and contracts and things like that, basically is worth 200 quadrillion dollars, if that makes sense. So this is the entire market is fucked basically. So if that makes sense. But anyway, we'll look at some stats, and I'll give you like some things to explain and stuff like that. So uh, gross market value of OTC over the counter derivatives, summing positive and negative market values, continue to decline. It fell by 13% in 2023 and then by 7% in the first half of 2024. Across risk categories, growth rates varied in the latest period. FX derivatives grew by a rapid 10% year over year to reach $130 trillion, with the increase of occurring entirely in the first with the increase occurring entirely in the first half of 2024. For their part, credit derivatives declined by 9% to 9.2%, while commodities and equities linked rose noticeably in graph 1b. Interest rate derivatives known as IRDs, the largest component of the global ag, rose by only 1% to 579. You guys, there is a market out there that where people trade derivatives, that they take bets that the Federal Reserve will cut by this much, the Bank of Japan will raise by this much. Those guys are the ones, if that market collapses, everything collapses. The interest rates market is where it's deadly, and things are happening. Now, as far as everything is concerned, I'll send you a copy of this report. There is no demand for American dollar as much as everyone says there is. There is no actual demand in terms of notional volume. There's not that much demand for annual growth for dollar. Where is the dollar? So others, dollar would be, where is the dollar? Dollar would be this line here. There's no demand, but there is demand for yen basically, and British pound is also down with the dollar. And where is US? Yeah, US dollar is this line here. There's not much demand, so the reason dollar should go down, based on what I told you in terms of volume and time taken to get to a level, we take the view that for the south side, Dixie dollar will go to 89 or 80 in the long term. Now, I want you to take something into consideration. As far as Dixie dollar is concerned, the move higher was achieved in a period of 2 months, but the move lower can be done much more quickly, more aggressively, once the commercials step in for Dixie dollar. As far as ICE futures is concerned, the futures Dixie dollar is not held by the CME group; it is held by our friends, the commercials. And at the moment, it looks like they're busy trying to take back open interest from these guys. But what the commercials do when it comes to dollar is to hurt the dollar. You go after government bonds, so they're busy shorting government bonds, thereby decreasing demand for the dollar. So because if these bonds, US 2-year, 10-year, and 30-year, they're paying out yields of 4.3% or 4% a year, then there is demand for dollar, because you can only purchase US government bonds through dollars, using dollars. So then they play a different game. So I think the last time we saw, they took out the largest position ever on the US 2-year. So we're waiting for that to happen. And moving forward, I don't know. I think Mary said that move on, what happened with Dixie Forex? What happened? As you can see, crazy moves like this, I don't even know. And that's actually, moves like this happen when the commercials are back in the game and stuff like that. So yeah, so we should see higher GBP, higher euro this week. I also want you to understand something when it comes to trading. Whenever a low is made, like a previous low is taken, the market will always go back to 100%. So this low here, there will be another attempt one more time to take it, and then they'll go high. So we are in the last, sorry, actually you don't have to wait. You can actually go long, because we're in the last week of November, and Monday will make the low of the week, basically. And this is a straight shot higher, basically. I think the aim is to bring back the month of, if I go to monthly candle, the last week of the month is about whether the monthly candle is an expansion or a retrace. So I think they should retrace higher back to 107, and that's almost 200 pip move from here where we are now. And yeah, and you can hold if you do decide to take this trade, I would advise to hold this trade until February next year, as a swing trade if anyone wants to take it. So let me just pause here.